The stock market is on fire. The S&P 500 just hit another record. Big banks are suddenly calling for 7,000 and optimism is running high. But whenever the market feels unstoppable, Michael Burry usually sees danger. And given his track record, from shorting housing before 2008 to calling out bubbles in meme stocks and crypto, his voice can't be ignored. So, which is it this time? Are we on the verge of another spectacular crash, or is this a rare moment when the bulls could actually be right? In the next few minutes, I'm going to lay out the scoreboard of where we are now and unpack why the big bank's projection is over 7,000. The small cap index is getting traction. Why are the bulls so confident? Revisit Burry's past warnings. And finally, I will share 3 possible outcomes for stocks between now and the end of 2025. So, before we talk about the future, let's take a clear look at the present. So, where are we really? The headlines say all-time highs, but let's slow down and unpack what that actually means. Right now, the S&P 500 is sitting in the mid-6,600s. That's a brand new record, and it sets the stage for those big predictions you've been hearing, with banks like Goldman Sachs, HSBC, and Oppenheimer saying 7,000 is now on the table. That's a big psychological milestone, but numbers alone don't tell the full story. Let's talk about valuations. If you take today's prices and compare them to expected earnings, the S&P is trading at about 22 to 23 times forward earnings. Historically, that's rich. And if you use the Shiller-Cape ratio, which smooths earnings over a decade, it's hovering around 39 to 40, also very elevated compared to long-term averages. What this means is that stocks aren't cheap, but high valuations don't automatically mean a crash. They just mean investors are paying up for strong businesses. And right now, the companies leading the market, especially in AI and cloud, are not just hype machines. They're producing record profits, massive cash flows, and in the case of names like Nvidia and Microsoft, earnings that blow past expectations. That's very different from the dot-com bubble, when companies with no profits were selling for sky-high prices. So, to sum it up, markets are expensive, but not built on empty promises. Profits are strong, money just got a little cheaper, and participation is widening. That's the scoreboard we're starting with. Now let's look at why so many analysts still believe 7,000 is not just possible, but likely. So if stocks are already expensive, why are some of the biggest names on Wall Street still talking about the S&P hitting 7,000? Let's break it down. First, the experts making these calls aren't fringe voices. Oppenheimer has the most aggressive target at 7,100. BMO raised its outlook to 7,000. HSBC says 7,000 is achievable, and Goldman Sachs recently bumped its target to 6,800. These projections are grounded in a few big themes. The first theme is earnings strength. Despite all the talk about recessions over the past 2 years, corporate profits have only grown. Tech giants tied to artificial intelligence are leading the charge, and unlike the dot-com days, their earnings are real and massive. Nvidia, for example, is producing record-breaking results that go far beyond hype. Microsoft and Alphabet are reporting billions in profits from cloud and AI services. That profit foundation gives bulls confidence that valuations, while high, can still be supported. The second theme is interest rates. In September, the Federal Reserve cut rates to a range of 4 to 4.25%, and they've signaled they're open to more cuts ahead. Lower rates make it cheaper for businesses to borrow and invest, but they also push investors out of safe assets and into stocks, especially growth companies that benefit from long-time horizons. When money gets cheaper, stock multiples often expand, and that's exactly what the bulls are betting on. The third theme is market breadth. For most of the last year, a handful of mega-cap tech stocks carried the entire index. But since the rate cut, small and mid-sized companies, tracked by the Russell 2000, have started to rally. A broadening market usually signals healthier momentum because it's not just a few names pulling the train. So when you combine record profits, easier money, and wider participation, you get the recipe that bulls say could take the S&P to 7,000 and beyond. But that's only half the stories because every bull run has its skeptic, and few skeptics are louder or more influential than Michael Burry. So why does Michael Burry's opinion carry so much weight, even when the biggest banks are shouting about 7,000? Because history has shown he's not afraid to stand against the crowd. and he's been right at moments when it mattered most. Burry first became a household name for spotting the cracks in housing before 2008. While most of Wall Street was partying, he shorted mortgage securities and made billions when the market collapsed. That one call turned him into a legend, and it also set the tone for his reputation. The guy who warns when everyone else is celebrating. And it didn't stop there. In 2021, when meme stocks and crypto were going wild, Burry warned about the mother of all crashes. In 2023, he tweeted a single word, sell, right as markets were surging. Even if you disagreed with him, those moments made people stop and think. Now, here's where it gets interesting. Burry isn't always bearish. In fact, recent filings from his fund show that in mid-2025, he actually leaned more bullish. That surprises people, but it's a reminder that his skill isn't just doom-calling, it's spotting when the crowd's confidence is misplaced. Sometimes that means sounding alarms, and other times it means quietly shifting with the tide. So, when Burry raises concerns today, investors listen. Not because he's always right, but because his voice adds tension to the story. Which brings us to the next big debate. Is today's rally just another dot-com bubble, or is it truly different this time? Every bull market eventually gets compared to the dot-com bubble, and on the surface, the story feels familiar. Exciting new technology, stocks soaring to record highs, and skeptics warning that it's all just hype. But here's the key difference. This time, the leading companies are actually making money. Back in the late 1990s, many of the hottest dot-com names barely had revenue, let alone profits. Investors were buying into dreams, not businesses. Companies with no cash flow were valued at billions, and when the promises didn't pan out, the entire bubble burst. Fast forward to today, and the picture looks very different. The leaders of the AI boom, companies like Nvidia, Microsoft, and Alphabet, are reporting record earnings, massive profit margins, and good cash flows. Nvidia, for example, just posted results that passed expectations, driven by real demand for its chips. Microsoft is pulling in billions from cloud and AI, services that businesses are actually using every day. That doesn't mean there's no risk. Valuations are stretched, and even profitable companies can get repriced if expectations cool or growth slows. But the foundation is stronger than it was in 1999. It's not just speculation, it's profits and adoption driving the story. So when people say, this feels like .com, the honest answer is, it rhymes, but it's not the same song. Which brings us to another important piece of the puzzle, how people actually feel about the market and the massive amount of money still sitting on the sidelines. Here's a strange contradiction. If you just looked at investor surveys, you'd think people were cautious, maybe even bearish. But if you looked at prices and cash flows, you'd see the market powering to new highs. So what's really going on? Take the AAII sentiment survey. Historically, the average reading shows more bulls than bears, about a 6.5% spread. But in mid-September, even as stocks were at records, the survey leaned flat to slightly negative, meaning the bears still had the louder voice. Normally, you'd expect that kind of pessimism when markets are struggling, not when they're breaking records. So how do you explain stocks rising when the investor mood looks gloomy? One word, liquidity. Right now, there's about $7.3 trillion sitting in money market funds. That's a record pile of cash, and as interest rates drift lower, the returns on that cash become less attractive. Slowly but surely, some of that money starts moving into risk assets like stocks. It's like a tide. Even if people are nervous, the flow of money still lifts prices. That's why analysts say this rally is climbing a wall of worry. It's not driven by euphoria. In fact, the skepticism itself may be fuel, because it means there's still money on the sidelines that hasn't capitulated into stocks yet. So, when you line it all up, cautious sentiment, huge cash reserves, and new highs, the stage is set for very different possible paths ahead. Some see a melt-up, others fear a crash, and many expect a messy middle ground. Let's break down the 3 most realistic outcomes for stocks between now and the end of this year. Let's start with the most optimistic path, the melt-up. In this scenario, the market keeps grinding higher, maybe with only shallow pullbacks until the S&P hits that magical 7,000 mark, or even pushes beyond it. What would fuel this? A few things lining up at once. First, earnings keep surprising to the upside. Big tech continues posting record profits, AI adoption keeps expanding, and corporate America proves more resilient than expected. As long as earnings keep growing, high valuations feel less scary. Second, the Federal Reserve doesn't slam the brakes. If they cut rates a little more or simply hold steady, that keeps money cheap and encourages investors to move cash out of safe assets and into stocks. Remember that $7 trillion sitting in money markets? Even a small slice of that moving toward equities would be a massive tailwind. Third, market breadth continues to improve. Small and mid-cap companies, which lagged for much of the rally, finally started participating. That gives the rally a healthier, more sustainable feel instead of leaning only on a few mega caps. Put all of that together, and you have the recipe for a classic melt-up: strong profits, supportive policy, and broad participation. It's the dream scenario for the bulls. But of course, dreams can be fragile. Which brings us to the less rosy possibility: a sharp bear market style snapdown. Now, let's flip the coin. What if instead of a steady climb, the market suddenly breaks lower? This is the classic bear market snapdown: fast, ugly, and emotional. In this scenario, the S&P doesn't dip a little. It drops hard, maybe 10, 15, even 20% in a short span. The stories fueling the rally quickly flip into excuses for panic. The same investors who were optimistic a month earlier start rushing for the exits. What could trigger this? Several things. The Federal Reserve could misstep, either cutting too aggressively and sparking inflation fears, or not cutting enough and choking growth. Corporate earnings could finally roll over, especially if AI spending slows or consumers tighten their wallets. Geopolitical shocks or trade conflicts could also pull the rug out. And of course, stretched valuations mean it doesn't take much bad news to send prices tumbling. This is exactly the kind of risk Michael Burry keeps warning about. He doesn't always call the timing, but his message is consistent. The crowd often underestimates how quickly things can unravel. A true snapdown reminds investors that stocks don't just go up smoothly, they can fall faster than most people are prepared for. But not everyone expects a full-blown bear market. Many believe the more realistic path is a messy middle ground, a choppy pullback, followed by recovery. The third path, and maybe the most practical one, is somewhere in between the melt-up and the crash. Think of it as a choppy pullback, followed by recovery. Here's what that looks like. The market, after racing higher, takes a breather. Prices slip 5, maybe 10%, as investors lock in profits and big institutions rebalance their portfolios. This isn't doom, it's a healthy reset. Corrections like this shake out some of the excess optimism, reset valuations a bit, and give long-term investors a chance to step back in. Seasonality plays a role too. September and October are historically choppier months for stocks, and this year is no different. Add in the fact that a lot of money managers like to reallocate positions around this time, and you've got a recipe for short-term turbulence. But the key difference from a true bear market is what happens next. Instead of spiraling lower, stocks eventually stabilize. Strong earnings and a supportive Fed keep the foundation intact, and the market gradually resumes its climb. By the end of 2025, you could still see higher highs, but with a few battle scars along the way. This scenario feels messy in real time, but in hindsight, it often looks like just another pause in a longer bull market. So, after all this talk of melt-ups, crashes, and choppy pullbacks, the real question is, what should you actually do? Here's the good news. You don't need a crystal ball. You just need a playbook that works no matter which path the market takes. That starts with position sizing. Don't bet the farm on any single idea. Spread it out so no one move breaks you. Keep some cash on hand, not to time the market, but so you can take advantage of opportunities when prices dip. Next, think in layers. If stocks run higher, your existing positions benefit. If they pull back, you can add at lower prices. If they fall sharply, your cushion keeps you in the game instead of forcing you out at the worst time. That's how long-term investors survive, by preparing for all seasons, not predicting just one. Most importantly, zoom out. Ask yourself, are earnings growing? Are companies still making money? Is the policy supportive? If the answers stay yes, then short-term noise matters a lot less than it feels at the moment. Want to know the 4 patterns that always show up before every major crash in the last 500 years, and how they're appearing again right now? Click the video on screen to see for yourself.